before I get to Vin, who was the first question, and then there's a Vin, and then there's a Vince, and then we've got Pat, and then we've got some other comments there. I got to go to Octavio very quickly. He asked a question about a management, which we sort of discussed a little bit, I believe, last week, but for a different customer. But Octavio sent me this position on IYW. I knew I was going to foul that up. He sold the 255 calls, I believe, when the stock was at 220, he said, or 210, and bought a September 290 call. This is a bear call credit spread where the stock is now in between the strike prices. So typical bear call spread, sold to open the 255, bought the 290. It's a fairly wide spread, and the stock has moved up against him and is trading between the strike prices. He wants to know what to do to protect it. Well, during our discussion we had with Octavio a couple weeks ago, maybe it was 2 weeks ago, I'm sorry, we were talking about a ratio covered call, and he was asking how to protect it. And I mentioned to him that, well, what is a ratio covered call? Well, let's say he owned 200 shares and he sold 3 calls, and now the stock was above it, so he's going to get assigned on the covered calls, but he's also got a naked call or 2 naked calls. I think it was 103 calls, so he was naked 2 calls. He was losing money because the stock went up because he's losing on the naked call positions that aren't covered. And, you know, I had mentioned some ideas about maybe making an adjustment here or rolling the short 2 calls out further and doing that. And he wanted to know, well, no, I was thinking about, you know, other than paying money, how can I do it for free? Well, there's not a lot of ways to do it. And in this case, I wouldn't try to do anything elaborate, Octavio. What do we mean by elaborate? I wouldn't try to sell 310 calls and turn this into a 3-leg trade so you're getting more credit, and now you've got naked calls combined with a bear call credit spread that's losing on a stock that's moving up. Okay, I think someone might say, yeah, you could sell 300 calls here. That would give you some premium in. You might raise this break even up, and you might have a V profit and loss chart. Well, let's just look at it. Go out to September, sell some of those 300 calls in this case. Oh, did they not add them, or am I not looking at? Oh, I don't think they added them yet because it moved up so quickly. All right, so let's sell the 295. So we didn't get them in the cycle spin yet. Now, this is extraordinarily risky. Why? Yeah, it didn't even do what you wanted to. It gave you a little bit of bump, another $1,200 of credit, but if the stock keeps going up, you've increased your risk dramatically, okay? Don't want to do it. Don't want to do that elaborate thing. The 2 things you could possibly do in this scenario is, number 1, close the shorts. You may be able to roll up to a higher strike price for a profit, but I doubt it, okay? One of the 8 ways we talk about managing a bear call spread. So if I bought back those 3 short calls, okay, and I know, not Fernando, I'm sorry, I know, Sam, you're going to have a comment on this, but if I bought back these for the high price and sold 3 here, it's not going to give me what I want. Okay, so it's going to cost me $24, $25 to buy to close those 3 calls per contract. I'm only getting 12 back on these 3. The premium up front wasn't enough to do this, so it wouldn't give me a good profit on this position, and you're still, you know, now, I'm sorry, I took it to 275 calls in this case. I'm sorry, still reading 255, isn't it? No, it's there, it's at 275. So now you're in a bear call that still has a profit as long as it pulls back on the position. But again, the stock's going in the opposite direction. Okay, so let me review that again. I sort of misspoke. We're closing the 255 calls that you sold. You're losing about $1 on those. Oh, it is working. Okay, and you're getting about 12 back for rolling up to the 275. Maybe even you could go up to the 280 and you just still have a small profit of 20, maybe 18%. Roll the short calls up with this sudden move that's happened. But again, it's going against you quickly, so you may not want to be in a bearish position. This is where you might want to consider that pendulum adjustment that we talk about. What's the pendulum adjustment? It's moving one option, the long option only, in a bull put or a bear call in this case, and swinging it down. You're going to roll it down actually to that lower strike, so with one move, you're going to convert a bearish spread to a bull call debit spread. That if the stock continues to move up, you can have a profit anywhere above 255. However, this is going to be very costly, and I'm not sure if the difference in strike prices are going to help you, although you did get a very high premium for this 255. So what are we here? We're 35 points apart. So what would I do to pendulum? I'm going to sell the September 290 call and buy the 220. And we're going to get a fair amount for that 290. We're going to buy 3 more of the 220, keeping it 35 points apart. What did you just do? Now you're only making 8.4% instead of where you're at right now at a loss, but what you did is converted this bear call credit to a bull call debit spread with a debit of 8,865. You rolled the 290, swung it down to the 220, bull call debit spread with a small profit that could be 8.4%. IYW continues to move up in price. So you could keep a bearish position and roll the short call up to maybe the 275, 280 strike if your expectation was the stock's going to stay here. If you have a feeling it's going to come up, I know this isn't the profit target that you want, but again, it is going to be very close to getting to a profit with the pendulum adjustment if you get the midpoint prices for all the various positions as well. Okay, so okay, let's see here. All right, so that's that. And oh, sorry, let me go back here. Okay, I see all the questions coming in. It's going to take us a while to get through them. Okay, all right, William there. All right, good. Okay, so that's for Octavio. The two ideas that we have there that one could look at to maybe potentially roll this position, Octavio. See which one best suits your needs and your expectation of the stock going forward as well. And I think Sam had a comment down there. I didn't see it all the way yet. All right. Okay, so let's take a break here. We're just going to run through some comments from Sam here that he started off. He says, hi, good afternoon to everyone in the room. Yeah, this was from 4:30. I know, 4:35. I'm sorry, Sam. So it did a profit on an Apple Bull Put. It was at 372.5, 370, and we just saw Apple at 370. He says, how can I profit on that? This is when it hit at 380. Bought puts at 380 2 days ago, and that turned into a huge profit when it dropped down to 36,250. So this is in relation to comments that someone asked me last week about adding extra puts to a bull put credit spread as a hedge. Yes, you can do that, but remember, if I've got a bull put credit spread in place and it starts to go against me, excuse me, in this case it worked for Sam. Okay, let's just get into the bull put search here. And we'll use Pepsi. And this will lead me to William's question that I'm going to bounce right back to Pat. Okay, so while I'm on the topic here, no, I'm going to take Pat first because that actually goes in relation to another question. I'm sorry. So if the stock started to go against me, not a huge return here, 8% high probability position, but as it starts to go against me, if I had bought, let's say, I'm in the wrong expiration. This is not, I'm sorry, this isn't the search I wanted, but that's okay. That's right. That was for last week's webinar. I could have just used it, but I'm going to go back to my 2 weeks. Hold on one second, and we'll get to Pat. Okay, yeah, I just want to keep in mind about the bull put credit spreads here. You entered it with a credit. Things were going good. That's better. You know, UNH here, 282.5, 280 for 14 days. Stocks at 300. Starts falling to 290. Well, at that time, I might buy 2 extra 270 puts, for example, or 275s, let's say. As the stock was falling, time had passed, so let's just say we buy another 1 or 2. Now I'm creating a ratio, but what is that doing if the stock rebounds? I've negated the profit to the upside. Sam's case, it was a smart move. He picked the time right, got the profits on those 2 extra longs, which countered the loss he was sort of taking on the other position, the initial bull put. It's kind of gave him a ratio where it got him a good profit. That's excellent. But I know Sam was prepared to do this. If it started to rebound and go the other way today, then he might have had to figure out a way to sell those puts and maybe sell to close those puts and sell to close others because you've just negated the credit in that case. Management doesn't come free is what I'm trying to tell you. Sam's aware of that. It's just a comment that we've talked about before, that management isn't free. And rather than trying to do some type of position in that case, yeah, you understand the risk is increasing, but you need to be on the correct trade. That's right. I understand that. And that was also in relation to the other comment we were talking with the initial calendar call spread. Kaushik has a long call that needs help with. Okay, we still got about 5 or 6 more questions, guys, so just bear with me. I know we're at 5:45 p.m. Eastern Time. We'll get through them all, I promise. GLD. bouncing around here, and I apologize for that. I want to clear some of this up so I don't go back to the wrong thing. All right, perfect. All right, EYW. I'm not familiar with this stock. Doesn't ring any bells here. And you bought in October, good, so you still have a good amount of time remaining in this position. 57 strike call. Okay, that's not too bad at all. That's not too bad at all. I bought one at 575. Okay. All right, so it's down. You're down about $1.70 on the position. Stock's at 58.91. Okay, so this goes similar back to what we were talking about before, Kaushik, related to the married put position and more. And what we're talking about with that is that there are ways to repair the long option. One of the things you might consider, if you're concerned about it stabilizing or falling further, near term, we might want to get some of this $1.70 you're down back right now by maybe selling a call against it if you have that qualification in your options account. This creates a calendar spread. So right now, we saw it down about $4, $4.05. So you're down about $1.70. We're making back close to a third of that, a little bit more than a third of that by selling this. Now, it doesn't look positive here, but remember, you're not trying to get to a positive return just yet. You might sell the 7th of August 60 call. If the stock stays below 60, that expires. Let's say it moves up to 59 or does move up closer to 60, 59.80. Well, if the 60 call still expires worthless, then you could sell the 21 August 62 or 63 for another 70 cents, and you're lowering this cost basis down, but at the same time, the call is gaining. If you're afraid that the position's going to continue to fall, this might be an opportunity, of course, to create something we said we normally wouldn't do, but you might want to look shorter term. If you think the fall is going to be shorter term, Kaushik, or if you think it's going to be longer term, I'm not going to go out as far as October. Let's just say for the next 28 days, maybe I buy a cheap put for $93 or $1. So you're adding money into the position to do what? Well, it means it's going to be harder if you get back to break even, but if it continues to fall, maybe that's not the best strike. Maybe I should take a 59 strike, in this case at the money, for more of a straddle position. But I mean, I went with the straddle, but it's a calendar straddle. So in this case, though, the upper and lower break even, $62 to get back, but if it continues to fall, then there. Okay, so this might not be the best play, but if you think it's really going to fall, I might just sell to close the call now, get out of it, take the loss, and look for another position if you're following this stock. But selling to open the call, creating a calendar, trying to hedge the cost basis, lower the cost basis as you go forward might be a good way to start getting to repair. But ask yourself first, before you do any repair, before you consider any type of management on the position, before you consider averaging down, rolling down the call to try to lower or average down as you would with the stock position, ask yourself, what is the sentiment of your stock going forward now? Forget about why you got into it. Forget about what it looked like when you opened the position. What does the trend of the stock look like now? And is it something that you want to consider to continue in a bullish position, or you want to get out of, to maybe go bearish or just move on? Before you do any management, before you try to adjust the position, ask if the overall sentiment of what you have in the position is still the same. Okay? And for a longer view on that, we just discussed this last week. You can go to the webinars page at any time. It is a public page, and many of these are available to the public. But go into options concepts. You see the first 5 are subscriber access only. But if you scroll down, you see a lot of other positions. I'm in the wrong place. Go to option strategies. Still go to the webinars page. Go to option strategies. Scroll down here to about 2016, 2015. There it is. Managing your long options positions. That's still available to you even if you're not signed in as a trial member or a subscriber. Just the top 5 are only available. The newest 5 are only available to subscribers. But you could go down here to managing your long options positions, Kaushik. That would give you some other ideas on managing the position. And in there, we will discuss, it will be discussed, reanalyzing the position based on where you are. Okay? Because you want to say to yourself before you do anything else, okay, that's what you want to see. Then there is no one answer to this question. I apologize for that. I'm not avoiding the question, but it's a tough one to answer, and it's, okay, we'll go this way. So we'll just ask the question. Vin asks, what is the best strategy to earn 4% per month? Consistently long-term, you can find covered calls that can generate 4% monthly, or selling 1 week out or 2 week out covered calls that would look like a 4% return. But to me, a reasonable expectation for a covered call strategy in the best of markets, neutral to bullish, you should only expect about 20% return. You're going to have losses. You're going to have to factor that in. Naked puts averaging 1.5% every 2 weeks or so. You might say, oh, well, that's 3% per month. I'm going to get 36%. No, because that's assuming that that stays consistent. You're going to have losses of 6, 7, or 8% that are going to wipe out 5 or 6 previous trades. In general, I'd say the safest way longer term, especially around an earnings season, to protect against the largest declines, if you're looking to generate a shorter term monthly or every 2 week premium and have protection in place so you don't suffer a 10, 15% loss with a covered call or naked put on the stock that suddenly moves against you, with a larger portion of your portfolio, mind you, Vin, okay, I would suggest long collars, honestly. And long collars, honestly, I don't think are going to give you 4% return, but I think a good, what I typically see on a good 3 week out, 4 week out, good long collar position is about a 2.83, 3.5% return if you're right and the stock moves slightly up and you get assigned. Ignore that one. Playing with conversions, not the best way to do it. And I wouldn't even do weeklies with these. I might go 2 weeks out, but I don't think I'd go weeklies with the collars. It's just too little premium up front. Yes, you can have a good risk-reward ratio. Okay, but some of these positions we're looking at here, you see here's some close to 3.7. But if I'm wrong on the stock, let's say I get into Activision here with this structure, and I'd probably be closer to the 80 strike. But in any case, Vin, a long collar position is a combination of what you'd consider a covered call and a married put. I'm buying stock, selling the call, and buying a put. And if the stock moves up and I get assigned, I make a good 2.5, 3, maybe 3.5% return, while only risking maybe 4, 5, or 6%. So even if the stock falls 10 or 12%, I'm not losing on this position. I'm losing something, but I'm not losing 10 or 12%, which would have wiped out 5 or 6 potential previous trades. I think collars are the most conservative for consistent gains. Might want to work on the structure a little bit, get closer to at the money to have a better probability of getting assigned and earning that return as well. I don't guarantee that the married puts are going to generate 4% per month. I trade this with 50% of my account, but there's some 25, 30, even 40-day cycles where I don't generate any premium because my expectation is the stock's going to continue up. Why do I want to handicap myself by selling a short call if my expectation is the stock's going to be 2 to 3 points above the call I'm planning to sell? I'd rather not put myself in a worse position and force an adjustment on my married put structure if it doesn't match my sentiment for the stock. And you say, well, don't you make a lot of money during the bull put credit spreads that you talk about or some of the counter calls? I do. But this would never, ever represent more than 15% of my total portfolio. I would not trade the bull puts or the calendar spreads with 40% or 50% of my portfolio, maybe even averaging 15% per month, because in an unexpected event, when we talked about this a couple of weeks ago, we've seen about 12 or 15 of them in the last 2 years where the market suddenly drops at the open, your 3 days to expiration, your bull put spreads are down 45, 50, 55%. I'm not trading that with 40% of my portfolio 50. I know the risks there that can happen, does happen, and has happened to me several times over the last 3 years. But because it's only 15% of my portfolio, on that day, like February 5th, 2018, when the markets fell down due to the trade war discussion in China, and all 3 of my spreads that had 4 days to expiration were at a 45% loss, that was only about 7.2, 7.3% of my total portfolio value. I can easily make that back up quickly. But if I had done it with 50%, right, I would have been down 25, 30% of my total portfolio. Can't have that. You can't do that. It takes too long to make back up, okay? So with the bulk of your portfolio generating income, seeing a consistent 4% return, I do at the money or maybe even slightly in the money collar, meaning you're selling your call at or slightly in the money in order to do that as well, okay? Okay, let me, Vince, before I jump to your question, that's all I have for Vin's question at the time. Let me jump down here to these other questions. Okay, All right. Vin, you're welcome. Yeah, long collars, that's what I'm doing, okay? Oh, Octavio says with a long collar, I'm sorry, what if the stock continues to move down? Okay, I'm not sure, Octavio, if you're talking about the collar position or if you're talking about your position. If it goes down, I'm out of the position. I'm going to go find a better trade. I'm not married to one stock, and I'm not going to try to stay in it with a short collar. This is a shorter term, 2 to 3, 4 week out trade. If it doesn't go as I want, I'm not going to try to repair it. I'm not going to try to fix the 3% loss by rolling the collar down or doing something else. I'm going to take my 3% loss. I'm going to move on to a position that shows me better characteristics and better technicals the next month. Now, if you're talking about your position, the IWM trade, I'm sorry, I'll just cover these both. We talked about 2 ways to manage. One, to keep it as a bear call credit spread and the risks involved with doing the bear call credit spread, raising the strikes if the stock continues to move up in that case, which it's doing. But if you convert it to the bull call debit and the stock starts pulling, oh, Jesus, I did that again. IYW. I keep saying IWM. IYW. I'm so sorry. There we go. Okay. So now you've had this sudden drop in the price and it's pulled down. Okay. And, you know, if this is moving in your direction, I showed you how you might consider repairing it, not protecting it, but repairing it. With the structure you sent me, you want this to go down, right? You want this to below 250. So I showed you 2 repairs, Octavio, in this scenario, to help you decide which one you want based on your sentiment. You could do either one of those. You could roll your short call up, stay in a bearish position, but have a better structure of it being at the 275 or 280, so if the stock falls, you've got more safety. Or you can convert it to a bull call spread with the 255 strike, and as long as the stock stays above 255, you make that 8.4% profit. Okay? That's based on your sentiment. I can't answer that question for you. All right, I can't make any comments as to the direction of the stocks. Good. Okay.